Great. Well, welcome everybody to our panel. The title of today's panel is Global Tax Reform Stalling. I'm going to give you a little bit of context before I introduce all of our panelists today. In October 2021, almost 140 countries in the world, it isn't quite 140, it was actually 136 to be precise, agreed to sign up to a historic OECD agreement on international tax reform, which aims to ensure that multinationals pay their fair share of tax and help countries prevent corporate tax avoidance and evasion. Now, it had two pillars. The first pillar, Pillar 1, which gives market jurisdictions further taxing rights on digital profits. Pillar 2, which is essentially a minimum corporation tax of 15 percentage points for multinationals so long as their revenues meet a certain minimal threshold. Now, I thought it was interesting that this week the OECD put out new numbers saying that Pillar 2, so the minimum corporation tax, should result in annual gains of over $220 billion, annual gains. That is versus their initial estimate of $150 billion, so it's been revised upwards. Pillar 1, the digital tax, is expected to lead to annual global tax revenue gains of between $13 to $36 billion, of profits of about $200 billion as well. Now, it must be said that in December, the EU also reached an agreement in principle to implement Pillar 2 in a way that is consistent and compatible with EU law. So, where do things stand today? How much progress has there been since October 2021? Are we going in the right direction? What is the future for this tax proposal? Those are some of the questions that I hope to get answered during this panel today. So I'm going to start off by introducing our panelists. First of all, we've got Matthias Cormann, the Secretary General for OECD. To his right, we have Zainab Shamsuna Ahmed, the Minister of Finance, Budget and National Planning of Nigeria. Welcome. We have Gabriel Zucman, the Director of EU Tax Observatory in France, and Faisal Ibrahim, the Minister of Economy and Planning of Saudi Arabia, young global leader as well. Matthias, I'd like to start with you. First of all, can you just give us an update on the progress that has been made since October 2021? How would you characterize the transition from commitment to actual implementation? And of course, I'm guessing that the EU commitment in December was a step in the right direction.
Well, look, I remain quietly optimistic that we will be able to reach the targeted implementation timetable of 2024 for Pillar 1 and Pillar 2. I mean, in terms of the opening question, is global tax reform stalling? My answer to that would be no. But, of course, I mean, global tax reform is difficult to achieve. It was never going to be straightforward. There was an agreement in principle in October 2021, which was indeed historic. It was a commitment to ensure that our international tax arrangements in a digitalized and globalized world economy are fairer and work better, and in particular that there was a fairer distribution of tax revenues into market jurisdictions. Now, in relation to Pillar 2, I mean, you've mentioned it, 27 EU member countries have now agreed by unanimous consensus to implement the agreement, which comes on top of countries like the UK, Switzerland, Indonesia, the UAE, Singapore, Korea, various others. And so, I mean, I believe that there is now very significant momentum around the implementation of Pillar 2. And Pillar 2 is designed in a way that makes it self-perpetuating, because it gives the right to those countries who legislate Pillar 2 to collect revenues that haven't, up to 15% of profits that haven't been collected elsewhere, for those countries that have legislated that deal to collect those revenues. And so it really becomes a matter of self-interest for countries that haven't yet legislated Pillar 2 in terms of their desire to protect their own revenue base, to follow suit and also press ahead with legislating Pillar 2. Now, in relation to Pillar 1, that's the most complex work. It requires a multilateral convention. We hope that the drafting process of the multilateral convention can be finalized by the middle of this year. There's still some, various areas where there is technical discussion. There's some public consultation processes currently underway. For example, on issues like how do we treat withholding taxes. Those who pay tax in market jurisdictions say that withholding taxes are taxes that they paid. They should be taken into account. Others say they were not in scope. And really, if withholding taxes are part of the equation, then we should should adjust the amount A. I mean, it becomes very technical very quickly. There are some discussions around. Obviously for those companies that will be required to pay more tax in market jurisdictions, the upside opportunity and the interest for them is to get tax certainty where there is a more consistent approach internationally. But then that means that those countries who have or who might be considering to pursue unilateral digital services taxes, that they either should not proceed or indeed withdraw those digital services taxes. So there are conversations around this and various other aspects. I'm not going to bore you with all of the detail unless you have some more questions about it. But the bottom line is this: a multilateral agreement that is swiftly, effectively, and widely implemented is clearly in the interest of the global community. It's the best deal that is currently on the table. We've got to be very careful not to let the perceived perfect be the enemy of the achievable good that is currently on the table. And in my proposition to all is that this is really the best opportunity the global community has right now to improve the way our international tax arrangements work in a digitalized, globalized world.
So you were just listing the countries that have made significant progress. One country stands out for not being there, and that is the US. Were you disappointed that the US, who were so instrumental in pushing this agreement forward, didn't actually include it in the Inflation Reduction Act? They included something similar, but it doesn't subscribe to the same elements of...
Well, I mean, the United States has legislated a form of minimum tax. You're right. It's not entirely consistent with the provisions of the global minimum corporate minimum tax as designed and as agreed in the context of the OECD process. But, we are part of the work that is currently underway is put in place appropriate bridges between different regimes to make sure that there is consistency in application. And when the democratic processes in the United States, in the same way as in other parts of the world, will of course continue to play out, and we would like to see all countries that have signed on to the agreement to fully, ultimately to fully implement both Pillar 1 and Pillar 2 once the multilateral convention is in place for Pillar 1, and indeed Pillar 2 can happen as of now.
Minister, I'd like to turn to you now. Nigeria was one of the holdouts on the deal. Can you explain to us why, and also what prompted Nigeria to go to the UN on behalf of other African nations to put forward a motion at the UN level to go ahead and do their own form of international tax reform?
Well, let me thank you for inviting me to be part of this session, and also for the opportunity for us to speak to how concerned we are about this process, and to emphasize that Nigeria is still on the table, is still engaging the process, and just seeks to have some improvements that need to be done to consider how this rule affects developing countries like Nigeria. The original intention, we were told, was to allow taxation of digital enabled businesses in market jurisdictions, and to understand the main challenges and obstacles facing implementation of tax agreements across the world. The question that we need to ask now is, has this key objective been achieved by this arrangement, especially considering the substantial percentage of digital-enabled businesses that have been excluded by the scope? For Nigeria, the answer is we cannot sign up to this in the way it is now. But if there's improvement, we are on the table and we are interested in still joining. And the reasons for us are, one, the negotiation, contrary to the agreed rules, was not based on equal footing. The laws that evolved did not carry the views of a lot of countries along. So mostly what is met are the views of the developed economies, to the exclusion of most of our own countries. The current agreement also does not deliver on the underlying objective, and the rules that are developed are so complex that it is difficult for us to cope with the implementation. So the rules need to be simplified. The pricing and the implementation are beyond our capacity to cope with right now. And also the narrowing of the scope of the rules, that medium-sized digital enterprises that dominate our markets are excluded. Most of the digital enterprises in our countries are the medium-sized ones. They're not the very, very large ones. And the outcome of this means that there will be also discriminatory taxes within our own jurisdiction. So we will not be able, if we sign up, will not be able to tax these medium-sized and small-sized businesses, while we are taxing similar companies that are Nigerian companies operating in the same market. So these are things that are important to us and need to be looked at. And maybe some variation of the rules, or maybe some stratification of the rules to meet the needs of developed countries. The agreement also seeks to prevent our countries from taking any step to tax thousands of out-of-scope digital companies. And for us, that's where most of our revenues are right now. So we have issues that need to be looked at, and we hope that the rules that are currently designed to be pro-developed countries will take into account the needs of our countries. For example, the income inclusion rule and the ordering of the Pillar 2, which ensures that little or no taxation right is preserved for the source countries. With this unfair design of the rules and the limitation of the scope to subject to tax rules, the IRR that will be used by developed countries will simply be used to mop up taxes from our countries. And we will end up with very little or nothing at the end of the day. So these rules are important to have global rules, but it's also very important that the rules should be fair, and the rules should encourage tax equity, and as much as possible accommodate the various variations of countries that are sitting on the table.
Very clear. I will give you a chance to respond, but first I want to go to Gabrielle. You've done a ton of work on global taxation. In November last year, you published a paper called Global Profit Shifting, which has showed that profit shifting has dramatically increased since the 1970s, essentially when a multinational moves its profit from a high-tax jurisdiction to a low-tax jurisdiction. To what extent do you think the OECD proposal is going to stop that type of behavior? And I guess the same question to that as a follow-up is, are you expecting multinationals to change the way they behave on back of this proposal?
Yeah, thanks a lot for the opportunity to be on this panel. And I want to start by saying that this agreement is really a step in the right direction. It's the first time that there's going to be an international agreement where countries agree on a minimum tax rate. We have many treaties that are about everything except tax rates, which is really what matters the most, for tax policy. It's going to make a real difference, especially Pillar 2, because many companies today pay less than 15% in taxes, at least in some of the countries where they book profits. And the reason for that is because there's widespread profit shifting to tax havens. We estimate with my co-authors that each year, almost 40% of global multinational profits are booked or shifted to tax havens, where they are subject to very low tax rates, of 5% or so. So this agreement is going to make a difference. That being said, it's also very insufficient, and it's also conceptually and philosophically flawed. It is insufficient because a tax rate of 15% is way too low. In many countries, the ratio of taxes to total income is 30%, 40%, 50%, which means that most social groups, the middle class, the working class, they pay 30, 40, 50% of their income in taxes. Now we are saying for multinational companies, it's okay to pay only 15%. Multinational companies, some of the most powerful economic actors, who've most benefited from globalization, it's okay for them to only pay 15%. It's very hard to understand for people and for good reasons. So that's the first issue. The second issue is that in practice, multinational firms will still be able to pay significantly less than 15%. And the reason for that is the big conceptual problem with this agreement, which is that not all profits are going to be subject to 15%.
There are carve-outs.
There are carve-outs, which are very large. And I want to explain that very quickly, because it's a really important philosophical question, and I'm going to explain exactly what I mean by that. The carve-outs mean that if you have sufficient activity in a country, you employ people, you have assets, then the profits that derive from that activity are not subject to the tax, the 15% minimum tax, or at least not fully subject to the tax. The underlying kind of philosophy behind that is that tax competition, when it's real, when it's real factors of production and employees, assets moving to low tax places, is legitimate, and there should be no floor to how low taxes can go. Even tax rates of 0% are acceptable. And I think this is the big problem. This is the big problem because if we keep having a form of globalization where there is no floor to tax competition, it means that who's going to keep benefit the most from globalization? Well, the most mobile factors of production, multinational firms, their shareholders, people who are at the very top of the income and the wealth distribution, and so it's going to fuel, to keep fueling inequality. And eventually this is not sustainable.
Yeah.
So that's the big problem.
Can I just ask you, that $220 billion that I mentioned at the beginning, is that, can you contextualize it for us? Is that a decent sum to be raised from this type of overhaul in tax?
It's decent, and I want to stress again that I do think that this is a step in the right direction. So $220 billion in extra revenue, and we obtained very similar estimates in our own work in the context of the EU Tax Observatory. So we think this is realistic. That's almost 10% of global corporate income tax revenues. That's a significant amount of money.
Yeah.
That's for Pillar 2. Pillar 1, most likely will generate significantly less revenue. But for Pillar 2, we're talking about significant revenues. And the reason for that, what it means is that you have many companies that pay much less than 15% today. Last week, the Government Accountability Office in the US released a report where they estimate that the effective tax rate for large US corporations after the 2018 tax reform in the US has been 9%. 9%. So, it's below 15. So It means 15 is going to make some difference. But of course, the big problem is why only 15? There could be much more revenue if it was 20, 25. I want just to finish with that last thing. In the mid-1980s, the average statutory corporate income tax rate globally was above 45%. Today, we are around 20, 25%. Okay, and we're saying, well, there should be a minimum of 15%. But historically, we've been way, way above that.
Okay, I'll come back to that. Faisal, I'd like to ask you about where does Saudi Arabia stand in terms of implementing this deal? And I think it's relevant because there is sort of a critical mass that's required for this deal to be successful. Is there a bit of a I'll go if you go mentality?
I'll be very frank with you. Saudi Arabia broadly supports this. There are some details that need to be sorted out, but we broadly support this because it's underpinned by the pillars of fairness. This is all about making sure that value and taxation are close to each other. And in that regard, I think in Saudi, under Vision 2030, we've been focusing on detaching ourselves from the traditional sources of revenue with our economic diversification to think about more long-term sustainable revenue generation, but also diversifying our sources of growth. So this will, as a byproduct, push governments to think about true fundamentals of competitiveness and competition at the same time. So this will drive productivity, this will drive competitiveness, this will take us away from the environment that had that race to the bottom with being too attached to fiscal incentives. Now, I agree we have to make sure everybody's at the table and listen to everyone. One thing we learned in the last 7 years is that voices are heard and collaboration yields results. So broadly, we're supporting this direction. We agree this is a step in the right direction. We feel that we have to stick to the time frame that's been set up with a multilateral agreement by mid-23 and implementation at the start of 2024.
Matthias, I'd like to go back to you. So there's a lot coming at you, namely that one of the criticisms of the deal is that there are many carve-outs. For example, I read on Pillar 1, once you adjust for all of the minimum thresholds, et cetera, you basically end up with a very small pie of around 69 companies that will end up being taxed. That's in Pillar 1. And the bulk of it is coming from US big tech firms. So it is a global deal, but from that sense, a local impact. Other pushbacks, we heard from Gabrielle saying that 15% is too low. And many concessions were not given to represent African communities. How do you respond to all of these?
Well, firstly, I mean, we've always said, and we still believe, that there's about 100 of the world's largest, most successful multinational corporations that are in scope for this deal, and it is a very substantial reallocation of taxing rights. And Pillar 2, as you've mentioned, we expect now to deliver $220 billion US per year in additional revenues, mostly benefiting low and middle income countries. Now, you know, some people have argued all the way through, instead of 15%, we should have 20 or 25%. But you know what? I mean, in the end, you've got to get consensus on something that will be implemented. And 15% is substantially better than 0%. And I mean, what we're trying to address here is, you know, a history now of tax evasion and tax avoidance, which has become much easier in a globalized, digitalized world economy. And, you know, in terms of the comments that were made, I mean, we very much appreciate our work with Nigeria. Nigeria is a deputy chair on the Inclusive Framework Steering Committee. Half of the members of the steering committee are developed economies. More than half of the members of the Inclusive Framework are developing economies. And you know, these are the decisions in the Inclusive Framework are made by consensus. Now, that makes it more difficult, it makes it more involved, and we are very committed. We will continue to engage with Nigeria and with others in relation to some of the outstanding issues on which we still are yet to reach consensus. Now, we do believe, though, that for countries like Nigeria, this is an incredibly positive deal that is on the table. I mean, Nigeria right now has one of the lowest tax to GDP ratios in the world, 5.5%, 5.56%. Across the OECD, on average, it's 34%. Across African countries in the broad, it's about 15, 16%. Now, we believe that both under Pillar 2 and Pillar 1, as currently designed, the Nigerian government will have substantially more revenue available to deliver investment, public services, and social protection to its population. Now, it's true. I mean, we can continue to have an argument around the world for a very long time that will never reach a landing. And we remain stuck at a level where we say, okay, we want the perceived perfect instead of pursuing the achievable good that's on the table. What I'm suggesting is this is a deal that has the most realistic prospect of any other deal on the table to actually make a tangible, positive difference. Let's make it happen. Yes, let's continue to work constructively and in good faith through some of those technical issues that are on the table. Yeah. But ultimately, let's not let this fail. Let's make sure this succeeds.
Why was there a carve-out for UK financial services?
Well, you know, in the end, this is not. We're not talking about carve-outs here about specific. Well, there's a carve-out in terms of Pillar 1. Of regulated financial services and of extractive resources, the resources sector. Now, what we're trying to achieve here is to address the risk of tax evasion and tax avoidance in relation to very mobile activities. And in particular, I mean, that's why the digital industry was so much in scope. I mean, the example that was just mentioned, I'm not aware of countries that would tax at 0% businesses in their jurisdiction with physical activity in their jurisdiction as part of an businesses' activities that can't easily shift to another jurisdiction are not the sort of activities that get taxed at 0%. The risk of harmful tax competition is in relation to those activities where companies can structure their affairs and shift their activities easily around the globe in order to get themselves the best possible tax arrangement. So here, I mean, we're trying to achieve the right balance, making sure that those companies that are generating profits in market jurisdictions but currently are not paying their fair share of tax in those jurisdictions, that we very much hone in onto those business activities to make sure that they pay their fair share of tax in those markets where their customers are and where they generate their profits. But we don't want to obviously create counterproductive distortions in relation to real activities and substantial activities in economies around the world.
Minister, I think that Matthias raised a very interesting point in that each country is coming with their own different structural setup. The number I think you said was as a proportion of total GDP, only 5% of
5.5% to 6%.
5.5% is coming from tax. And African nations in general rely a lot more on corporation tax than on other types of taxes. Just to give a number that I read, in 2017, African countries raised 19% of their overall revenue from corporation tax, compared with an average of just 9% for OECD members. So are a little bit more reliant on those corporate tax revenues.
Well, those numbers are correct, but also we believe if there's a global initiative, you should consider different sizes of countries that are on the table. Why do we have only the largest MNEs under consideration? Why can't we have another pillar that addresses medium-sized companies, which are the majority of the companies that are operating in our jurisdiction? So if we sign up to this, it means we're excluded from getting taxes from medium-sized companies that we now actually, by our own laws, have an opportunity to collect taxes from. And I do understand and appreciate your situation, Matthias, that progress needs to be made. And we support this initiative. We're on the table. We're just asking for a reconsideration of some of the commitments that have been made, so that we're not going to end up, if we sign up to this, our analysis is we are going to end up with negative tax. So taxes that we used to be able to collect from these medium-sized companies, we cannot collect. The majority of the companies that are in this rules now are not operating in our jurisdictions. So there's a need to reconsider how to make either some amendments or how to add another scope that helps us to capture more of the companies that are operating in developing economies like Nigeria.
Is there any overlap between the proposal via the UN, what you're pushing for at the UN level, with the existing OECD proposal?
There is, but the UN proposal is kind of more straightforward and simplistic, but the limitation it has is it has to be based on bilateral tax treaties. So that's a huge limitation. We hope also that can be corrected. The complexity, like I said earlier on, is also a very important consideration. One of the reasons why we have a lot of profit shifting and tax evasion in our countries is because of the limitation of skills of trying to identify these practices, trying to even implement our own laws. So when you are now made to sign, or you commit to sign to a process that is complex, you're providing more room for those leakages to happen. The carve-outs, I just don't understand why some of the analysis we made from those carve-outs, while it is written as 10%, could be effectively as low as 2 to 3%. So there's a need for a reconsideration, and it's not to say you can't move forward with the first effort that has been made, but there's a need to quickly look at some other additional variations so that countries like ours, even some of the countries that have signed up to, are also now rethinking. Because when you go to your parliaments, these questions will be asked. And how do you get these laws passed in your jurisdictions if the analysis shows that you end up with negative revenue inflows as opposed to gains?
Very clear. Gabriel, I want to go back to something you said earlier, which is, in general, corporate taxes have been dropping since the 80s from about 45% to around 20%, I think now you said. What I thought is interesting is, in the last couple of years, more so than ever, countries have been focusing a lot more on their own fiscal situation. And you can't talk about tax reform without thinking about it through the lens also of the public finances and what pressure countries are under to bolster them. I thought it was notable that in the UK, for example, recently they have actually reversed their policy on corporate taxation. Corporate tax is set to rise from 19 to 25 percentage point. I think only one of 2 OECD countries that has announced such measures in recent years. Do you think this era of the race to the bottom on corporate taxation is coming to an end?
Unfortunately, no. I really wish I could have a more optimistic answer, but what you have to realize is that with the agreement as it's going to be hopefully implemented in the near future, there is going to be very strong incentives for countries to keep offering low tax rates even lower than 15%, to attract activity on their territory. It's true that today there's no country where there is a lot of substance, meaning there's a lot of production happening with a 0% tax rate, but we might well go there. Today we have countries where there's a substantial production happening with rates that are below 10%, especially tax rates for income derived from intellectual property with all patent boxes. It's very common to have rates that are 5, 6, 7%. That's the situation today, and we might even get to less than that in the future, because the agreement doesn't put a floor to tax rates, to how low tax rates can go when firms have real activity. And so I'm really concerned about that. And the reason why I'm concerned more broadly is that you have to take, a bigger perspective on tax systems. The corporate tax is one tax, but it's not the main source of tax revenues, at least in most countries. However, the reason why it matters a lot is because it's essentially impossible to have a progressive individual income tax, which is in most countries the pillar of tax progressivity, the way we attempt to tax high earners. It's impossible to have a well-functioning individual income tax without a well-functioning and high enough corporate tax. Because if the corporate tax rate is too low, then what happens is that rich people incorporate. They operate as businesses. They earn income, subject to the corporate income, the low corporate income tax rate, and the individual income tax unravels. And so, if we want to do anything seriously to curb the rise of income and wealth inequality, it's going to involve progressive taxation of income in particular, and that needs to involve substantially higher corporate income tax rates. I don't see a future where corporate tax rates remain, 15% or even less than that, and we can really tax high-income earners at substantially higher rates, I think. And so the risk at the end of the day is just to see a continuation of the rise of income and wealth inequality that we've witnessed in recent decades.
There's an important point here, though. I mean, what we're trying to address with the global tax deal is tax evasion that is facilitated by shifting from country to country. I mean, the issues that you raise can be addressed now by individual jurisdictions. I mean, the global tax deal that's on the table, through the inclusive framework, does not prevent countries from imposing higher corporate taxes. It's a minimum global tax. It does not prevent countries from addressing the risk that you describe of incorporating yourself in order to avoid higher progressive personal income taxes. I mean, these are all things that individual jurisdictions can address for themselves, subject to their democratic processes. The reason why there is a need for an international agreement to address what we're seeking to address is because of the capacity for big multinational businesses to shift their affairs and to structure their affairs such to essentially pick the jurisdiction that gives them the best deal, and then in the sort of whole process also, I guess, provide, put pressure on some countries to offer deals that, quite frankly, are tax wasteful. So, I mean, I don't think that the deal that is on the table would prevent individual countries from doing what you're suggesting, if that is what they choose.
Respectfully, I disagree with that, because if there's no limit to tax competition, it's very hard for individual countries to increase their corporate income tax rate if firms can move their factories, can move their headquarters, can move their employment to low tax countries where they will still be subject to tax rates below 15%. So I'm sorry, but this agreement doesn't help countries to increase their corporate income tax rate, unfortunately.
Well, substantive activity is not shifted as
No, but that's the same problem, and it's even worse. Shifting paper profits across countries, no pure profit shifting. I agree with you, is going to be very substantially reduced thanks to Pillar 2. And I started my remarks by saying that it's a very important progress, and it's worth celebrating progress when it happens. So pure profit shifting, booking billions of dollars in profits in territories where there is no activity, this will come to an end. Those profits will be taxed at least 15%. And that's a very good development. However, what is not going to change, what's not going to change is that there will remain incentives for firms to move not their paper profits, but their factories, their workers, their headquarters, their real activity to very low tax countries, including zero tax countries.
It's going to be difficult.
That's an even bigger problem. That's an even bigger problem.
It's going to be difficult to come up with a solution on this panel, but also one solution that works from the very first draft. And this is the first draft of serious international tax reform. And as all of you have said, it is a step in the right direction. But there are a few lingering issues. Faisal, I'd like to sort of round up the discussion with you. Saudi Arabia is actually in a special situation, contrary to what Gabrielle just described, because there's no income tax, but there is a high corporation tax. Corporation tax is about 20%, I think, in Saudi Arabia, but of course no income tax. How do you think about tax as a tool, or maybe a blunt tool, in terms of wealth distribution?
So I think we have to keep in mind that Saudi managed to increase VAT from 5% to 15% during one of the most challenging times. And according to Kristalina yesterday on the Saudi panel, it's virtually the only country that was able to do that successfully. So we look at simplifying tax revenues and utilizing them in a way that was never done before, but not at the expense of economic growth or economic development. So Saudi has been a supporter of this Pillar 1 and Pillar 2 from the beginning. During the G20 presidency led by Saudi Arabia, it was pushed all the way to paving the way for it to be announced during the Italian presidency. I think there are challenges. One, we need to, as we said, listen to all constituents and leverage multilateral platforms to enhance the institutional capabilities of all governments, all players, all partners. I think with better institutional capability, we can shift the focus from minimizing the change or minimizing the impact to where else can we compete. And I think the ultimate long-term effect of all of this is that we will look at competitiveness and fundamentals that will help our economies become more sustainable, rather than rely on fiscal incentives that will probably take us nowhere. There's another thing that's challenging in this, and we still think sticking to the time frame is important, is its complexity. This is very complex, and it takes time for everyone to understand it, including governments, and to understand how they will be impacted, where, and to what end. And ultimately, there are always options. But if you extend the investment horizon a little bit and think more long-term, I think and couple that with raising institutional capabilities everywhere, we can think more broadly about what these can push us to do. But it's very complex. I'm pretty sure if we go to ChatGPT, we'll get no answers. If you put
one thing they don't have an answer to.
The other thing, just one last point. I think companies say there are admin costs related to it, but the structures will shift and will become a little more logical with minimal distortions. It'll cost us a lot to get there, but a steady state, I think it's more logical.
Well, we've got about 6 minutes. I want to see if anyone in the audience would like to ask our panelists a question. I'm going to open it up. Yes.
My name is David Böcking. I'm a journalist with Der Spiegel in Germany. Tax consultants have historically been really good in finding the loopholes in new legislation. How confident are the panelists that this will not happen with this new agreement, especially in developing countries, that the tax administrations there have enough resources to actually enforce these rules?
Well, I mean, a big focus of our work is on supporting capacity development in developing economies. I mean, it is a real issue. There is a real challenge there. And that is also why we're having conversations, for example, in relation to the transfer pricing provisions on simplified arrangements. I mean, it is a challenge. It's something that we've got to make sure that we continue to work through. But I mean, we do believe that this is a robust deal. I mean, it is, you know, in the end, if you want to get consensus among 140 odd countries, you have to get a lot of different perspectives onto one table. And, you know, in the end, we can say, I say it again, I'm repeating myself, we can say, well, let's hold out for the perfect, where we have got no risk and no issues, and but it doesn't happen. Or we can go ahead with what is, in my opinion, the best available deal on the table right now, make it work, deliver the additional income, in particular to low-income and middle-income countries, so that they can invest those resources into their economies and into their communities. But of course, I mean, you know, this is to implement this effectively will take a lot of work, and there is, you know, in particular, a lot of work to be done on capacity development in developing countries. Mm.
Do we have another question? Would you like to take a crack at that?
Add to that I'm actually pretty concerned about this happening, because it has happened in the past. So when harmonized transfer pricing regulations were introduced, you know, in a number of OECD countries, we saw that this was a boon, you know, for the transfer pricing industry. We saw an explosion, you know, of activity in the transfer pricing industry to find loopholes, and very little or sometimes no positive effect on tax revenues. And this is a very, very complex agreement, and I'm very concerned that this might play out again in the future. I would just like to add something that you know, relates to the need for unanimity or consensus. All of these discussions start from the premise that we need to have all countries and territories on board. We have to question that, because if we have that approach, in effect, it gives a veto power to countries and territories that benefit enormously from the status quo, that benefit from profit shifting, that benefit from tax competition. And that's how, at the end of the day, you have significant loopholes and carve-outs that are introduced in the agreements. And so there are other ways to proceed. So for instance, when we look at what happened for bank secrecy, there used to be a strict bank secrecy in countries like Switzerland, in other tax havens, but this changed not because of a consensus. It changed first and foremost because of the United States, because of unilateral action by the United States, you know, in 2010 with the Foreign Account Tax Compliance Act that threatened Swiss banks with economic sanctions, and under those threats, the banks agreed to cooperate with the US, and that it paved the way for a multilateral agreement. But historically, progress often happens like that. There is unilateral action. It could be one country, it could be a group of countries showing that we can do better than 15%, could be 25% minimum tax rate, and then it creates a dynamic for ambitious global agreement.
We've got about 2 minutes left. Matthias, I just want you to spell out to the room what you think is at stake if this agreement does not get implemented.
Well, what is at stake is about $220 billion in additional revenue that's on the table from Pillar 1 that would benefit all countries, but in particular, except for investment hubs, who lose tax base and tax revenues, but which would in particular benefit low-income countries. What is at stake is the implementation of a reform agreement that would make our international tax arrangements fairer and work better. Will everybody unanimously say this is the perfect thing and the best thing since sliced bread? No. But is it better than what we currently have? Substantially better, yes. Should we give, I would just urge everyone not to give up on this, not to give away this chance to substantially substantially reform the international tax arrangements to make them fairer and work better for the 21st century.
Final word for the Minister.
Well, I just want to appeal to OECD to also make sure that as you're seeking these tax reforms, which we agree with, that you're not leaving some countries worse off than they already are, or completely leaving out some countries in the bargain. Because I believe with just a little more effort, there can be a way to accommodate some of the concerns that the African countries have. So it wasn't just Nigeria, it was a meeting of African countries that agreed for Nigeria to submit on behalf of African countries the concerns that we have. So it wasn't just Nigeria.
Well, look, I'm going to end this by saying at least we're sitting here and having this discussion, and that is a step in the positive direction. Thank you very much.
Thank you.